Hey everyone, welcome to another episode of the Adventures of a Real Estate Investor. I'm Susie.
And I'm Michael, and we're excited you join us for this adventure.
So today's very special guest is Kim Kesterke. Thank you so much for joining us today.
Yeah, thank you so much for having me.
No, I'm super excited. And just to let our adventurous family know, so I met Kim through GoBundance. Her and I are in the same GoPod, and it's just really been an awesome experience. Like GoBundance as a whole is great, but being in your GoPods, it's like we meet once a week and we really just dive deeper on, well, we're all in real estate, so that's cool, but like just dive deeper on life as well. And so I've just been so fortunate to be able to meet you. It's been a pleasure.
Yeah, absolutely. It's been a lot of fun.
Yeah, absolutely. So obviously Susie knows a lot about you, but I don't know much about you other than what Susie's told me so far. And our adventurous family would like to know more about you. So would you mind sharing with our listeners a little bit more about your background and why you started investing in real estate?
Yeah, absolutely. So I started investing in real estate back in 2006. And initially, I had purchased my first home as a private owner. And back then, if you guys remember, there was a lot of appreciation opportunity. Everybody was getting into the housing market. It was it was a huge buzz. And so I was around 26 years old at the time. It was my very first property. And what I ended up finding is it was a great experience. But then in 2008, two things happened. As we all know, the economy tanked and I found myself $30,000 underwater. And then the second thing that happened is I was transferred from where I was living to another city that was about 3.5 hours away. So I didn't have $30,000 to take to a closing table. And I was really young at the time. So I thought, why don't I put some renters into the property and wait for it to go back up and then I'll sell it.
Mm-hmm.
So what ended up happening is I started remote managing that property without even knowing that it was a thing, and had a couple wins over the years and really started enjoying it. And so that's really what prompted me from going from, say, accidental landlord to real estate investor. I started acquiring more and more duplexes, triplexes, and just different properties over the years.
I wish I was you when I was 26. No, that's awesome.
Thank you. Yeah.
So with the wins, like when, I guess, and this is kind of like a tough question to answer right at the beginning, when did you experience then like the loss and how did you keep going from there? Or if you have experienced a loss, actually.
Yeah. So there are always ups and downs in real estate. So it's not always just one smooth sailing. I wish it was, but there were just little continuous wins and then little continuous losses. It's almost like the stock market, right? It goes up and it goes down and you just kind of have to ride the wave. And I think the biggest one that was very impactful was when it was almost like a sewer issue at the property. And I was 3.5 hours away. I got a call from the tenant. They're like, it really stinks in here. We don't know what's going on. And so I went and I got a plumber out there and their first quote was about $3,000. And that's a lot of money. Still to this day, I hate seeing quotes that are $3,000. And so I got a little bit overwhelmed just thinking, oh my gosh, did I bite off more than I can chew? What am I going to do here? Well, I ended up calling another plumber. And this is why it is so good to get two quotes, because the second plumber went out and was able to use an organic substance to go into the crawl space, clean it up organically. It didn't require all of the fancy tools that the first plumber had recommended or was proposing. And it went from a $3,000 quote down to, I believe it was $400 at the end of the day. Wow. And that's really what taught me to, number one, call around, but then also too, there's always another solution. There might be a more creative solution. It doesn't always have to be the most expensive solution to get it done. So they were able to go in, fix that section of the pipe. It turned out a tree root had grown over time and damaged the pipe, and everything was fine. So there's little wins and little losses along the way, but that was one that I really remember completely.
Yeah, sounds like a stinky situation.
Yeah. I wouldn't have wanted to live there, but they were really good sports about it and was able to turn it around in a couple of days.
Oh, that's awesome.
Yeah. So just curious, as you continue to build your portfolio, did you focus on the same area? Like, are all of your single family and small multifamily stuff like in the same area, or did you move to different markets? How'd that work?
Yeah. So initially, I started acquiring right around the same city block as my first house. So I was able to get a couple duplexes and even a triplex within a 1 mile radius of where that original property was. And then as I got a little bit more advanced and started trying out other strategies, and especially because I've been remote managing since 2006, something out of a different city isn't as intimidating to me as it might be some newer investors. So I've been able to pick up properties. I have one in New York. I've got one in North Dakota. I've got one in Arkansas. So it's just kind of the numbers work. I'm just starting to acquire outside of the state of Georgia.
Wow, that's cool. So do you still remotely manage all of these, or do you have a property manager now?
I finally wised up about 2 years ago and got a property manager.
And
it just it once you get a certain amount of properties, I think it's really wise for somebody to make the investment, get somebody who's local,
Mhm.
boots on the ground. They're also one thing I learned is they're most likely going to be able to negotiate better rates with the contractors. Because when you're an out of town investor, a lot of these contractors will be like, hey, I mean, I'm just going to charge. Usually there's a premium as an out of town investor that I notice. So with property managers, they're local. They know what the rates are. They can negotiate better on your behalf. And so you're ending up saving money in the long run when it comes to repairs and that sort of thing.
Gotcha. So you have multiple property managers then? You have some in Georgia, New York, North Dakota, Arkansas. You say Arkansas?
So I have one that's handling all the Augusta properties. And
Okay.
then I've brought some of the properties closer to me in Marietta. And I have a property manager there. And then the properties that I invest in that are in New York, Arkansas, and North Dakota, those are a different strategy altogether. So what I call those is more, I'm the bank in those. I was able to pick those up for cash. And then I presented owner finance terms. So the buyers have actually bought the property from me and they're paying me like the bank. So I don't have to worry about maintenance. I don't have to worry about any of that stuff. I just have to worry about procuring a buyer. And then at that point, they are responsible for everything.
That's really cool.
You're
Susie probably has questions to ask too. But this is something we haven't talked about on this show. Is just owner financing, how you did that, and like, could you explain a little bit more in detail about that whole process, and like why you
Yeah,
decided
so
to move to that? Yeah.
sure, absolutely. So I love the strategy and it's one that I'm even learning more about. So I joined a buyer's group and this buyer's group had access to homes that maybe have been foreclosed on or kind of sold back to the city. And so you could get them at really good prices. So these particular houses I paid about, I would say 20,000 to maybe the most 25,000 cash. And they're not in the best condition. So I do have to say the disclaimer there. They're not in the best condition. But what I found is if you do very light work, like for instance, if the windows are boarded up and you take the boards off and you pay somebody to fix the windows and do some very light exterior, secure the exterior, then a lot of buyers will come in and they're going to want to do the work themselves because they might be buyers that aren't going to qualify for a traditional loan. They might be buyers that just, want to buy something that's more in the 50,000 or 60,000 range and not in the crazy prices that we're seeing now. And so you organize the terms. And so what I do is I usually do a percentage down of the down payment, and then I will just not prorate, but amortize the payments, define an interest rate. Here's the payments, and then here's the payoff. And usually I hold the loan 10 to 15 years, depending on where that person wants the payments.
And Michael's like, I'm so amazed.
Yeah.
Cool strategy.
fun.
Yeah, absolutely. Yeah.
Like, I know, the more that we educate ourselves and just like the more knowledge we bring in, like the more confident we get with certain strategies. So were you more confident with that because the terms always worked for you, or like what made it where you were like, yes, this is definitely something that works for me?
So I took a shot on, this is the New York property, and it was offered through the Buyers Club, and it was about $18,000. So you can imagine this day and age. I mean, I bought it about a year and a half ago. So this day and age, a property that's $18,000 isn't going to be in the best condition. But the group that I had joined, they had success. They were like, listen, you go in, it doesn't necessarily matter the condition. You just go in, you put a sign out in the front, you put it on Facebook, you market it, and there's going to be people who are interested that have the chops to fix it up. So when I got the pictures back, I thought, well, there goes my money. Like it was in a rough condition, right?
Yeah.
And I sold it within a month and a half.
Wow.
And I'm telling you, like the buyer, like we'll text back and forth every once in a while. He's handy. He's happy with it. We came on terms that really worked, and I'm getting passive income on it. He's getting a good price. And he said to me, he said, listen, I wouldn't have been able to get a house, and rents these days are so astronomically high. So it's a win-win all the way around. And that's actually what proved to me that this strategy does work. You know, it's a little scary to just buy something sight unseen and go for it, right? And but the strategy works because there's a lot of people out there that can't get conventional loans, are paying a lot of money in rent. And I just really think this strategy can work for a lot of people, not just for the small little, I call them grab bags, right? You know, it's just sight unseen. This could also work for a house that you can get from a wholesaler for $50,000. And that's in better condition, that all the person has to do is do cosmetic things. It's a great strategy all the way around, depending on how much money somebody has to invest and budget.
It's cool. Just curious. So you bought it for 18,000. Like, what did you end up selling it for? And like, if you don't mind sharing, like, what kind of interest you're getting and stuff like that.
Yeah, sure. So that particular one, because it was in pretty rough condition, I ended up selling that for $37,500. And we're amortizing the loan over the course of, we did a 12-year loan because he wanted to actually bring down the payments slightly. Mm-hmm. And I'm at an interest rate of 9.9% on that one. And cool. So if you amortize it all the way from the down payment all the way through for 12 years, I'm looking at around $58,000 to $60,000 on my 17.8 investment.
That's cool.
So it's better than if it was sitting in the bank, right? Because I understand we're facing inflation. I understand that the future cost of money is less than the present cost of money. But the way I want to invest is I want cash flow. So I want to be able to know that I'm getting this monthly payment in every single month for the next 12 years. Mm-hmm. For me, that's how I want to invest my money. There's other ways people can do it, but it's better than sitting in the bank and I'm helping someone along the way. So that's really how I look at it as a whole.
That's really cool. I like that.
Right. And how many properties do you have like that?
So I have 5 like that. And I just picked up another one.
Oh, yay.
Yeah.
Do you think you'll do that? Sorry.
No, you can go.
I was just curious. You think you'll continue with this strategy or go back into the traditional buy and hold or maybe a little bit of both? Or
I want to do a little bit of both. Okay. So I really do like this strategy. And it's almost like now I want to go from the $20,000 properties and bring it into more of the $50,000. Do you know what I'm saying? So it's almost, I was able to get my experience at a lower cost of investment. And they all ended up turning out, which is really awesome to see. You know, despite the condition, they all sold. So now I'm looking at it. All right, well, I did it on kind of these smaller properties. Maybe I can now like save up 50 grand, do it on a 50 grand property and kind of just accelerate even more in the sense, you know, because the spreads are going to be better. The returns are going to be better and the payments are going to be better. So that's really my next focus.
And what kind of like due diligence do you do on like the owners or the buyers? Since they can't qualify for a traditional loan, I mean, like what kind of due diligence are you doing on them to make sure that they can make your payments?
Yeah, definitely. You have to make sure. So you put the down payment to something that's affordable, but that you kind of screen a lot of people out with the down payment. That's number one. And then if they're willing to do the down payment, then you look at proof of income. Like you got to have pay stubs. You got to be able to see that there's some savings in the bank. So typically if they can make the down payment on this particular New York one, the down payment was $2,500, which is great for that person. But there was a lot of people, they screened themselves out just on the down payment. A lot of people are like, oh, could I do payments on the down payment? And you really got to look at it as you got to have someone that can pay the down payment, not in different installments. Mm-hmm. They got to do one lump sum. That's a win. And then provide proof of income.
Yeah. Gotcha. Cool.
That is cool. Do you have more?
Yeah.
No, I think that's really cool. Because I was thinking, I was like, man, this is like, if only this existed for more people, helping more people who are potentially homeless people who can't afford rent, but like they had a little bit of money, but like I said, they couldn't afford rent, but they can't qualify for a loan. They can't get a house. Like this is really cool opportunity for them to do that. And you're providing the opportunity. And it's like I was just thinking about like all the big institutions out there who are like, nope, not lending money to you. And then just like walk away, and it's like devastating to a lot of people. And then you are single-handedly with you and this buyers group as well, like single-handedly like helping people out, which is really cool, leaving an impact. Yeah, love it.
Yeah, it really is. I'm very passionate about it because as I've gotten into this and have placed more buyers, right? Every single person has said to me, I feel this is too good to be true. And it's not. I mean, I'm making money on the interest, right? They're getting something under what they would have to pay for rent or equivalent. But honestly, let's be honest, it's probably under rent at this point because rents are going up. They're getting something that's fixed over time. I'm getting a good interest rate. I'm getting a return on my investment. And then in return for the interest rate that I'm getting, they get the future appreciation. And it's really a win-win all the way around. And I really love that strategy because of that, because I think the onus now with institutions charging higher interest rates is for investors like ourselves to take it more in the private sector, just like how landlords had to take it to the private sector when government housing wasn't necessarily the ideal. I feel like we as individuals investors are going to now have to take it to the private sector to do fair loans. And it works all the way around when you really slice it and dice it.
That's cool.
Yeah, I was going to say, like at the beginning, a year and a half ago, he might have been like, oh my gosh, that interest rate is really high. But I'm sure now he's like, it's going to be even here soon. And my rent is way cheaper than I thought it was going to be, because like it skyrocketed in the last year and a half. So like that's kind of cool to even look back at and see like where he might have even not thought he benefited by the 9%, where now he's like, okay, I'm up along almost with everybody else. Like we're good, I mean, and I totally
it's almost
on your end, like, because you have to, right? You have to make that cash flow also.
Mm-hmm.
Yeah, it's almost matching inflation at this point, which, is, but not quite. And I also see that it's a good return on the initial investment, no matter which way you look at it.
What do you recommend for somebody who like wants to start getting into owner financing?
Yeah, it's a lot easier than they think. I mean, I was introduced through a buyer's club, but you don't even necessarily need a buyer's club to get started. You can just go on to Zillow. You can go into whatever state you're looking at and you can do a filter, right? Just anything below $40,000 or anything below $30,000. There's not a lot that pops up, and you do have to be pretty careful about, which houses you choose. You want something that's livable is really what my advice would be. I went in and just did 100% blind. Let's just try it. And it's walked out, but I don't recommend it. As I've really tailored this strategy, I would say, go on to a Facebook group, find somebody that could go walk around the property. Even if you have to pay them $50 to do so, it's better to get more of the advice from somebody that's local, figure out what would that, particular property need. Then you want to go on Neighborhood Scout, which is a free website, and you want to be able to check the city itself. You want to make sure that it's got a decent population. I would say at least 20,000 people, which it sounds very tiny, but 20,000 is a pretty good size that can support industry. And you want to make sure there's jobs. And Neighborhood Scout shows you all of that for free. It shows you through the different tabs. You just want to make sure that there's employment there and that there's population there. And once it hits those criteria, then it's a pretty safe back of the napkin evaluation at that point.
That's awesome.
Mm-hmm.
Have you only done it with single families, or have you done it with? Oh, okay,
just single families, but now I'm really starting to get this creative financing bug. And instead of going off the MLS or this buyers group, my next phase is I really want to start reaching out to owners. And so that's kind of phase 3, right? Actually having conversations with people that want to sell their houses that they might not be in the best condition. They may not sell very well on the MLS for whatever reason, and then start buying properties that way, because then I can then negotiate terms with them and then flip it around and sell it on terms.
Yeah.
And then that way it's less cash out but you're still getting the spread between your payment to the original seller and the new buyer.
I like that. Yeah.
Yeah, I didn't think
That's
about
cool.
that. That is cool. You've like opened up our eyes just to something brand new. It's like, oh, new shiny object. We're
Yeah.
screwed.
I mean, like 1 degree
Yeah.
further than that would be like note investing, right? Like you'd find distressed, people who can no longer afford their payments, and then you buy the house for them and then negotiate new terms for them to live in that same house, right? Something
Yeah.
like that. I don't know, but I don't know
Yeah.
much about note investing, but yeah.
Yeah, I've taken a class on notes investing and I like it. I think I'm more tangible. So I think what I'm doing is the same, right? I'm taking a distressed property, I'm getting somebody in and making it now a non-distressed property through them going in, doing the maintenance and that sort of thing. I think with notes, it was just hard for me to figure it because it's more you're flipping paper. And with this strategy, you're still kind of flipping the house in a way.
Tangible asset. Yeah.
Yeah, it was like tangible is kind of how my brain perceives it. But one thing I do want to advise everybody before buying a property, make sure that the title is clear. I'm actually in a situation right now that it turned out the title wasn't clear. And so we're working through that. I'm working through getting it, just quieting the title is the term. And just, I could have avoided a lot of that if I would have, run it through a title search company. It was pretty much, I negotiated terms with the seller and then resold it in a sense. So we're quieting the title. Everything's going to be fine. But there are due diligence things that people need to do and be aware of.
Yeah, that's a great point. Any other due diligence things that you've learned throughout this whole process?
The biggest thing would be make sure the city can support a buyer. So that would be the city size, and it would also be industry. So I learned this, and the house still has sold. So there's still been interest, but it took a lot longer because the city was a very small town and they depended primarily on oil and gas. So, believe it or not, when the oil prices went up, I thought that would better support this community, right? But it ended up really, for whatever reason, it didn't. It took the jobs even more away. I think maybe because they were depending a lot on pipeline and that sort of thing. So I think that was probably the primary reason why. So you just want to make sure that you have enough other industry. I usually say 3 different industries, right? So if oil and gas is one, there should still be some sort of medical community, or there should still be like maybe another factory there that can really support jobs. If it's just one thing, it's going to be a challenge to sell the property there. Just as if we were looking at it as a rental to rent out to somebody, you got to make sure that the industry can support it.
No, that's great advice. Thank you. Because
Yeah,
I don't know, it's just cool to hear it from a different perspective. Even, as real estate investors, it's like, oh, that was a little reminder that we know is there, but sometimes we forget. So thank you for sharing all of that.
Yeah,
absolutely. So it's been a pleasure chatting with you, Kim, and it is really cool. I'm glad you're able to share this knowledge that we haven't shared on this podcast yet.
Yeah.
It's really cool to learn about it, and I'm kind of excited. I'm like, maybe we should do that now.
Yeah, right.
Or at least dabble in a little bit. We'll see. But that brings us to the Adventures 4. These are 4 exploratory questions we ask all of our guests. So if you're ready, Kim, we will start the questioning.
Okay, sounds good.
All right. So the first question we have for you is, where is one place you wish to travel to and why?
Yeah, so I've always wanted to go to New Zealand just because I've heard it's absolutely gorgeous and there's really good hikes and really good scenery. So that is definitely on my list to travel in the next year or 2.
Maybe me, you, and Ingrid can go to a GoPod adventure.
Let's do that. Yeah. We'll have a mastermind.
He's like, I'm just chop living. That's cute.
Cool. You guys have fun.
Yeah.
The second question is, what is one thing on your bucket list and how are you leveraging real estate investing to achieve it?
Okay. So there's a 30-day hike that's across France, like basically the top part of France all the way to Spain. And and I've always thought it's really cool. I believe the name is like the Camino de Santiago. And if I am butchering it, I apologize, that it's something that I'm really, really interested in doing. It takes 30 days to do. It's one of those things that at each little town is set up for the tourists to come in. So you basically hike from one little town to the other and you follow this trail all the way through. So, when it comes to leveraging real estate to do that, obviously, I would want the cash flow to be able to cover it while I'm gone for the 30 days. I need to have my systems in place so that things are handled so that I don't necessarily have to work while I'm doing that. And it's just, I think it would be a really cool experience to do once in my life.
Yeah, totally. See, look, we can do that one together.
It's a really cool one.
I like that a
I
lot.
like that. Yeah, absolutely. The third
Yeah.
question we have is, what is one piece of advice for someone who wants to start passively investing in real estate?
Yeah, there's not just one solution, as we talked, or one strategy, I guess, is the way to look at it. So I would really encourage somebody who wants to start to take a look at what do they have available to them. Is it cash? Is it time? Is it other resources? Because here's the thing is someone might have a lot of cash, a great credit score, and they can go in and get a conventional loan on a duplex or a fourplex and start that way. But then somebody else might have a lot of time and no money, and they might be able to start investing through the wholesaling way to build up cash reserves, which that is a little bit more active, not passive, but they can build up cash reserves to then go put that into a passive investment like this owner finance approach or more of the conventional route. I think a lot of people get stuck on the fact that there's only one way to do it. And then they think, oh, this isn't for me. This is too hard. I don't have enough this. I don't have enough that. But if you really break down all the different strategies out there, there's something for everybody. And they just have to educate themselves on the different strategies out there.
That was a great answer.
Yeah.
Thank you. And then the fourth and final question is, if you had unlimited resources available to you, how would you leave an impact?
Yeah, I think we really hit the nail on the head in the earlier conversation. If I had unlimited resources, I would be buying up a lot of these homes and just selling them and making housing a little bit more affordable for people. It's not scooping up everything because, as we talked about, it's got to be the right town. It's got to have the right metrics, right? But, there's a lot of dilapidated properties out there that could be fixed up and that people could live in. And that's 100% what I would do if I had millions of dollars at my disposal.
Love it.
Right? I do.
I thought that might be your answer.
Yeah.
Yeah, I know, right?
Awesome.
Go retire and live on the beach. No, I'm just kidding. I don't think I would love that for maybe 30 days. And then I'd kind of get bored and then I'd have to go back to doing some real estate investing.
Yeah.
Awesome. Well, before we end the show, would you mind sharing with our listeners how they can get a hold of you if they want to reach out?
Yeah, sure. So listeners can reach out to my website, and that's www.theww2landlord.com. So W2 landlord is, people that have full-time jobs or full-time gigs still want to invest in real estate. So W2landlord.com. And then I also have a Facebook group that's called W2 Investors. And we're growing every day, and people will contribute different projects that they're doing, questions that they have, just, classes that are being hosted. I really try to encourage people posting what they need on that group. So it is an active community. So definitely anybody's welcome to join it.
No, and it is a great Facebook group, so definitely check it out. I'm a part of quite a few, and I was like, I like this one. That is really great call interactions. But thank you, Kim, for joining us today. It's truly been a pleasure.
Yeah, this was a lot of fun, and thank you so much for having me.
Absolutely. It's a pleasure. So until next time, explore more adventure ways.
Woo!